Welcome back to another episode of FPOG, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about JP Morgan's Global Family Office Report. We're going to talk about what is the family office, some of the highlights of it, or our highlights, and then what does this mean for oil and gas professionals? Justin, I'm excited to dive into this piece because family offices are they're just so popular, right? I feel like there's a lot of momentum in the profession towards family office, and that term is thrown around loosely. But to have a report that compiles 190 of some of the biggest and most important family offices in the world that are at the biggest bank in the world, I feel like it's a really fascinating look under the hood. And even if you don't have a family office or even know what that is or ever think you'll have a family office, I think there's things that can be taken away from this report. But Justin, I feel like we need to take a step back. For those who don't know, what is a family office?
That's a great place to start. I would say that a family office is a private wealth management team that works only for one or a few families. And I think it's helpful. JP Morgan in this report did a good job of segmenting three different types of families that employ or start or have a family office. They broke it down from 50 million in family assets up to about 500 million in family assets. They consider that small on the family office spectrum. Medium-sized, Jared, I think it was 500 million to 999 million. And then large was $1 billion or more. And so, a very wealthy family who is employing a private wealth management team specifically for their family's planning needs as it pertains to investments, tax, estate planning, family education. So imparting financial wisdom onto the next generation. Cybersecurity was also cited several times in there. So anything pertaining to properly managing wealth and the wisdom that pertains to wealth falls under that family office spectrum. What would you add, Jared?
So I would just delineate, there's multi-family offices, depending on how we define a family office, which your definition may be even more confusing by the end of this podcast after talking about them. Multi-family offices, there's multiple, resources shared by a small number of families. And a single family office is, hey, all of the employees work for the singular focus of execution of the family's strategic and financial planning and investment management plan. This piece of research is single family offices, which I think we can learn a ton from, even though, I bet we do have a few of our listeners that have thought about that idea and kind of thrown around some numbers in their head of, okay, at what point does this make sense? But even so, just understanding the most sophisticated families, how they're setting up their balance sheet, what's on their mind, how are they operating, what are they outsourcing, what are they insourcing, who are they hiring? I think there's a lot to be learned from that.
That's a great way to frame it. And Jared, I think there's something to learn for every listener in this. I think you're going to find this fascinating if you're in the accumulation stage and you are in your 30s, 40s, and just starting to accumulate serious wealth. I think it's fascinating everywhere on the asset spectrum, whether you have a few million or a few hundred million or billions. And, we have some listeners in all of those categories. I think there's a lot of lessons that you can gather from what family offices are doing. But boy, I also think, Jared, you mentioned something that we could make an entire podcast on. The definition of what a family office is could be its own podcast, because there's the Walton family office, you told me the other day, it has hundreds of employees. And then on the other end of the spectrum, there are solo investment firms that if you go to their website, it's one person working in their basement and they're marketing themselves to the public as a family office for specific people. And so there is a huge spectrum of what a family office can mean.
Yeah. And it's also a function of, hey, what's execution, right? Like investment, like family office can have hundreds of people, and some of them are it could be all admin, it could be all legal, it could be all philanthropy, right? Really depending on the composition of, okay, how is capital being allocated across this family's investment mix? So Justin, let's dive in. So just at the 10,000 foot level, we'll also share this piece of research. And so you can see it, follow it along. I'll try to notate pages and things like that. So 190 families participated, and about 144 of those were families in the US. 46 were globally. We'll focus a lot on the US because it's kind of the peer group, if you will, that we're most interested in being an investment advisor in the US. So one call out here, this is a pro-Texas podcast. The highest represented state in terms of family offices, 22% of the family offices surveyed are located in Texas. So what is that, about 32 or 33-ish of the family offices are in Texas, more than Delaware, more than New York, more than California, more than Wyoming. Does that surprise you at all, Justin, or is that about what you'd expect?
Jared, I think I wasn't surprised that Texas was at the top or near the top. What did surprise me was in this JP Morgan report, I mean, I need to look back at the specific slide again. I want to say that Texas was multiples higher than number two. And so a really large plurality here from Texas families who have a family office. So interesting.
Yeah. And I think Delaware is kind of a throwaway state because I don't know what percentage of the family offices are actually located in Delaware. They're probably just incorporated in Delaware because of corporate structure benefits of incorporating in Delaware. So Delaware being number two kind of feels like it's not a true number two. If you actually decompose those corporations and saw, okay, where are most of their employees and assets domiciled?
Jared, I do want to ask you Justin, one question that I find super fascinating real quick. So many of these families are from Texas. We don't have this data. I would be very interested to learn the generation prior, were they in Texas? And then 2 generations prior, were they in Texas? I'm sure you know what I'm getting at here, that I would guess that if you go back to the grandfather of grandparents of the, family lead today in Texas, I bet most of them were not living in Texas, which is interesting in terms of the migration of wealth. Also interesting to think that it's hard to predict where pockets of America, where the global economy will be in 60 years. It's easy for me to think that, well, yeah, my kids are just going to live right down the street from me. And so will my grandkids and pass it on from there. But no, there really are. It's so hard to predict where things will be 60 years from now and where the economic opportunity will be.
Yeah. And this whole concept of family offices, I think it's fairly new, right? Like if you look at the data, and I think this is on page 14, but if you look at the median number, I like median. I think I'm going to use median a lot more than mean in this podcast because there's some firms at the high end that might kind of skew the average. So I think median might be a more helpful number for us to plan. But the median number of generations served is 1.9. So about 2 generations, right? So I might argue, in the scenario you did, most of those family offices aren't even 3 generations old, right? Or they're fairly new, or it's the current liquidity event and it's really been instituted. If I think about 2 generations, it's really just the wealth creators and their children is probably how a lot of it shakes out. That's the majority of family offices. So still kind of remains to be seen. And I would say this is a demographic in this niche of financial planning is probably a little in flux. And I mean, based on some of the data we're going to talk through, kind of try to figure out its identity, I would say.
Great point.
Cool. Well, Justin, let's talk about, I think a good place to start is, okay, like you and I were talking about, okay, what should we do? So we've defined what a family office is, but like, what does a family office do? And so if we look at page 18, it's talking about a U.S. overview and the primary services that were being cited. I'll just read them out. Managing financial assets of the family. 95% of family offices said that was a big service that was offered. Succession planning and preparing for the next generation. 70%. Wealth advisory. 65%. Impact investing and philanthropy. 51%. Concierge and lifestyle services. 44%. And continuing the entrepreneurial legacy of the family. 43%. Justin, does that smell right? And are there any of those where you're like, I'm kind of surprised that's on here? Are there any that aren't on here that you're kind of surprised that aren't incorporated in terms of family office objectives?
I think maybe I'm a little bit surprised that more concierge services aren't highlighted more throughout this entire report. Certainly, when I think about the difference between, let's say it's a $100 million family and they're deciding, should I work with Brownlee Wealth Management or another RIA, or should I go hire 6 people to live in my town and work exclusively for me? I think one of the bigger delineations, Jared, is, well, a family office is going to execute your bill pay. They're going to kind of take care of your schedule and different items around the house. They're going to be coordinating, different private jet schedules and different home maintenance items. I think about a lot more concierge services being a little bit of a differentiator between a traditional investment firm versus a family office.
Yeah. I mean, the first four objectives are all things that we help families with.
Yes.
Right.
Great point.
And so, yeah, I kind of agree with you. Like, and we'll talk about, okay, what size are we seeing family offices? I might not even say it's a size; it's more of a complexity thing, right? Like if you
Yeah.
have if you have a holding company and multiple businesses, and you take a trip and use one of the company planes, or if you use a personal plane, but part of the travel is for one entity and another entity, and you need to keep books of all of these different things, and your balance sheet has a ton of illiquid assets, and you're just trying to figure out how to manage capital calls and all the complexity, and you have a family limited partnership with four different LLCs within that all that have tax returns, right? Like regardless of the dollar amounts that's associated with those, there's a baseline amount of complexity where, hey, you need a full-time person on your hand to kind of manage all these things. And so, concierge and lifestyle services, like kind of like you're talking about bill payment, I would say like, cash management and not like, optimizing yield on cash, but making sure that, hey, all the entities have the appropriate cash structure and that they're making payroll, if you will, because a lot of those entities have a lot of expenses. So I'm kind of with you. I'm really surprised that concierge and lifestyle services were lower. But yeah, I mean, it doesn't surprise me that 95% say managing financial assets of the family is the objective. I would say like that's kind of the mark of like if we were to define a family office, I think managing the assets of a family is a great summary. I think financial is just one component of it, right? Like I think, you have a lot of business assets and you have a lot of multi-generational assets and legacy assets. You have probably a big donor advised fund that might not be a financial asset for you, but for people or a foundation. And you have human capital assets that need to be capitalized, kind of pointing back to James Hughes' book that we talked about a few months ago. But I think, right, like if we were to say, hey, what does a family office do? I would say it manages the assets for a family with multiple generations in mind. I think like is the easiest, cleanest definition we can get. But kind of like you, I am surprised at how many firms or investment advisory firms that aren't family offices provide most of these services that are outlined in the objectives.
Great point. And I think complexity is such a critical data point because if you think about some of the larger families we serve, there's a really wide, delta between, okay, some families have an incredible amount of trust entities that already exist. And then others are more simple. And it is, Jared, I would argue it's possible if we just think personally that it's not outside of the realm of possibility that a family worth $80 million could have a more simple, more straightforward, less complex situation today than a family with $8 million. And so a lot of it is complexity driven. What are the assets? How many trust entities are there? How liquid are the assets? How liquid are the trust entities? And all of that really is a driving force of what the family needs.
Yeah. And we can talk about this later, but like I would bifurcate like life complexity. Like a client might choose that, right? Like have multiple homes and they have multiple businesses and, a bunch of different entities for tax advantages. And then there's like investment complexity where like, okay, do you need it? Right. And so there's a really good kind of question. And we have a good counterfactual of like essentially the opposite of this that I'm excited to dive into later. Okay. So we talked about the services, like kind of the objectives. Okay. Why does a family office exist? Like, I think a good next place to go would be, okay, who is this for? And you kind of talked about the three different cohorts, but the median, and this is on page 21 of the report, but the median net worth of a family office is 626 million. And then the median assets under supervision is 476 million. Justin, any thoughts related to that? Is that about what you'd expect or any surprises there?
It's right in the ballpark of what I would expect. I do think some of the big differences between those numbers, and Jared, maybe it's a question to debate, is what does the liquid asset number need to be at to constitute, formulating a family office? There are, multi-billionaire families that maybe liquid assets are in the tens or hundreds of millions, but I could go either way on does it make sense to organize a family office And I think a huge part of that is, well, what part of the family's balance sheet is actually liquid and up for debate? If 99% of the assets are all in a privately held business that you're going to continue to operate for another 10 years, I think there still is a use case for a family office there, but it's very different than a family that is post-exit event.
Yeah, I guess none of these numbers really surprise me because if you think about the cost of a family office, which we'll talk about next, right? There's a baseline amount of assets that are needed to support a sustainable withdrawal rate in a family office, right? Like if you have millions of dollars in family office expenses and you have a $5 million portfolio, your family office is only going to exist for a couple of years in a bull market, right? So there's a baseline amount of expectation that doesn't surprise me. I guess the one thing that's interesting is assets under supervision is a funky number to me. Like, what does that mean? Like if I own a privately held business, is that number included? My guess is my property is not included in that, but is, what is included under that supervision number? I think would be really kind of interesting because I would love to see, hey, what percentage of this is a privately held business? What percentage of this is just public equities? And we could talk about the equity piece later, but assets under supervision is just a little squirrely to me. And maybe it's intentionally that way. But even so, assets under supervision as a percentage of the total is about 75%. So 25% is not under supervision. So my guess is that's super liquid, super privately held stuff. And, kind of you and Nathan talked about that in the earlier podcast. If you want to have $100 million plus, you need some sort of liquidity event, privately held business you're not going to get there by maxing out your 401k and diversifying your RSUs unless you have a very, very low cost of living, unless you're on the fire train. So I think that's really interesting is, how private investments are definitely a part of the equation. And I might even say illiquid business holdings. And I would say that's even different than privately held investments because illiquid investments, you typically just outsource to a manager, but like privately held company stock or something you have decision-making control over that, is also likely probably not in that supervision number, but I would be curious.
Great point. Like Nathan and I shared about a month or two ago, if your path is getting to 200, 300, 400 million in net worth, well, that's just not happening at ExxonMobil, unless you're Darren Woods. And just like you mentioned, that's where the crux of this, which is such a fascinating topic that could be multiple podcasts on its own, that's where that comes to play. I mean, the way that you hit those higher net worth numbers is you have a private business that you scale to 8, 9, and 10 figures. And how much cash does that spit off? Is there an exit event? Should there be an exit event? Or should you try to own this privately held company for 100 years in your family? So many different kind of planning implications stem from that.
Yeah. And my guess is if you looked at the the family office accumulator, somebody on the family office trajectory, my guess is they had a higher percentage that wasn't under supervision, right? They've likely de-risked their portfolio now that they're a family office, which is more, I would say, in preservation mode than risk. Like, you're trying to risk manage and you have a very diversified portfolio because you've already beaten the game. Right. And so my guess is if you looked at these families and you looked at this, assets under supervision at various stages in the family's life cycle, it'd skew lower percent of assets under supervision.
For sure.
Awesome. Well, before we talk about costs, let's talk about, so this is kind of a breakdown of services. This is on page 30. It talks about services and how much are outsourced versus which services are in-house. So I'm not going to run through every single one. But, 62% of family offices do investment management in-house. 78% of family offices do private investments in-house. And then some of the other high ones, I would say over 50%. Balance sheet aggregation and reporting, 76% do that in-house. Financial administration, 86% do that in-house. Family office staffing and compensation, 90% do that in-house. I don't know how 10% don't. And then concierge and lifestyle services, 67% do that in-house. Justin, are there any, and then, one more, philanthropic services, 78% do that in-house. So do any of those numbers surprise you, or do you have any thoughts related to, which of the services are being insourced versus outsourced?
Yes, I was very surprised by investment management. I did not expect that a huge number of family offices in the US and abroad are outsourcing investment management. I found that super interesting. And Jared, that's correlated to our next topic, which is cost. I find it super fascinating that the median family office is spending seven figures to establish their family office. And then they are outsourcing investment management. So they are paying a different party to execute run investments. And that's a regular common thing for family offices to do. So I was pretty surprised by that. I definitely expected more family offices to execute the investment management in-house rather than outsource it. What about you?
Yeah, I mean, well, this is one of my big takeaways, but yeah, how much investment management is outsourced? Like, I think cost frictions, and like later on, I'll unpack all of the potential layers. Yeah, so that kind of surprised me. I mean, I would say what didn't surprise me is the percentage that we're doing balance sheet aggregation, financial administration, like all of those make sense. Because getting back to why I think a family office makes sense is like baseline complexity on your balance sheet. Like you need people to just manage the flow of money, of bill pay, of
Yep.
bank accounts, of trust distributions. Like all of that stuff really seems like the most compelling way versus, hey, I want a really excellent investment management experience. And like we live in a golden age of investments. I think what's available in public markets and private markets for qualified investors is remarkable. And it's better than it's ever been. But I think, a lot of times people in generations prior, like I couldn't source investments really well, right? Like I couldn't, like 50 years ago, I couldn't buy an index fund. And so like
Yes.
thinking through, okay, like what structures are needed in place now in light of the publicly available universe. And so yeah, I did think it was kind of an interesting little cost friction. This one I didn't really talk about, but legal services, 83% outsource, estate planning, 66% outsource. I was kind of surprised by those numbers, right? Like if you want magic to happen, and we talk about the idea of coordination as having a bunch of professionals that are collaborating. And like if I were gonna have a family office, I would definitely want my estate planner talking to my attorney, talking to my investment manager. I would love all of those people to be in a room. But I'm surprised the percentage that outsource that. RIAs have to outsource that because they don't have those people on staff. But I thought family offices might. But it is one of those things where it's not really in the top five strategic objectives of the family office. But I was surprised by that.
Great point. Jared, I think in the coming years, it will be interesting on the investment management front. I think our firm or a firm like ours is positioned to be a pretty major player in that space. If you're a family office and you need to allocate 200 million to public equities, it makes a lot more sense to pay a fixed fee to do that and have 200 million on Fidelity or Schwab's platform than it does to, hire any sort of percentage of asset manager. And so, kind of an interesting thing where I think our fixed fee model will continue to be a growing major player in this space over the next 10, 20 years.
Oh yeah, absolutely. Because I mean the costs are exorbitant, right? Which isn't surprising. So if you look on page 72, the median total cost to run a family office is $1.4 million, and so that's a lot of money. So if you think of 5% distribution rates attainable, you need and I don't know if you spend a couple $1,000,000 a year, but just to sustain that family office expense, you're already putting yourself. Justin, how much is that? I'm struggling with the
So,
quick math here.
I was kind of messaging you about this morning, and it comes to the total fee question because if you have 600 million and let's say 1.2 to 1.3, 1.4 is going to your family office, that's more than 20 basis points right there. But Jared, you then take that cost data point and you align it with the allocation. And the biggest allocation for all of these 190 families was alternative investments, which are significantly more expensive than public equities. And so you have more than 20 bips already going to family office. You then have significant expense within the alternative space. Jared, it's not crazy to think that a lot of these families, especially if they're under 1 billion, are spending more than retail investors that have 6 or 7 million on a percentage basis. which I find that to be a little bit crazy. And I look at their return assumptions. And I mean, Jared, I don't know about you. I would challenge a lot of the philosophical underpinnings that are building family offices today.
Yeah, like if you look at their balance sheet and their return targets, there seems to be a disconnect in my mind.
I totally agree.
If you look on page 42, it says, which of the following best describes how investment decisions are made at the family office? 56% said by the family principal. So let me get this straight. We have full-time people on staff who help us with investment management. Also, the majority of these investment managers outsource to third parties.
Yes.
But then the final decision-making is the family principal. And then assuming that the allocation is to a lot of underlying illiquid investments with sub-managers, there's another layer of expenses and rationale. And of course, the family principal making decisions, there's not a dollar cost, but there is a time cost, right? Like if I have a family office, like I want to delegate that decision making. If the final decisions are going through me, do I really trust my family office to execute? And then what are they helping me with? And then it kind of gets back to, they say investments, but it seems more administrative in nature. So I think there's just this weird conundrum where it feels like there's too many cooks in the kitchen and there's a lot of complexity, and you wonder how much of it is just inherited, right? And I get why it exists, right? Going back to the fees, there's tons of money to be made. But the question is it all necessary? And I don't know. I don't know if it is.
Great point. On the one hand, one of my favorite proverbs is, if you're doing something great, you need guidance. If you want to win, you need many advisors. And so that is a good thing on its surface. And then on the other end of the spectrum, Jared, I absolutely wonder, are there too many cooks in the kitchen? So fascinating that the majority of these families, at the end of the day, the key family leader is making the investment decisions.
We'll kind of use this to segue into, okay, like what are the return targets and then what are the underlying investments? If you look at the percentage of US family offices that have a long-term target return, 49% said yes, 51% said no. They have all these people and all this complexity, and they don't even have a North Star. They don't even have a way to find whether or not the firm, maybe they do, but from an investment perspective, they don't have a target return of just even a bogey to say, hey, have I beaten this? And of course, I would say like a return number might be an incomplete, like Sharpe ratio, risk-adjusted return might be better, right? To kind of quantify it. But even then, do you have a long-term target return for the family office portfolio? 51% said no. And we'll go back to median, because I think there's a few outliers of people that say crazy things, but the median return target is 8%. And okay, so if you think about the people that have said, hey, I have a return target of 8%, what has the S&P done since like the 1950s? It's compounded at like a 10%, over 10% annualized. So if your target return is 8% and there's in public equities, you can get that for 3 bips. Why all the privates? It just doesn't make any sense to me.
Boy, what an interesting point. And yeah, mean to median is important here. The return expectations, median was around 8%. So Jared, I cannot let this podcast finish without calling out. I cannot believe the material number of family offices that are expecting 15, 20, and more than 20% annual returns. I think it's nonsensical. I don't think it makes sense. And the only way it adds up is if a very substantial portion of the family's balance sheet is in a well-run private business. What do you think about that, Jared?
Yeah, I would agree. So if you decompose the US, so 41% of investors have long-term return targets of 10 to 20%. Only 3% have over 20%. So there's not a ton that are just completely losing their mind. But if you think about it, right, like you're right, like having a business that can compound at a higher rate, like privately held businesses where you have decision-making control, that's the easiest way to compound wealth at an above average return. But the thing is, if you look at the underlying holdings, they're in the most expensive stuff. And yeah, there's going to be potential increased returns, and we can debate that in a lot of the alternatives, but that's what they're allocating to in hopes of achieving this excess return. But Justin, I do think it's like just still crazy to take a step back and say, hey, so half of the people don't even have a return. And of the half that do, 48% think the return have a long-term return of 6 to 10%, 8% have a long-term return goal of expectation of 4 to 6%. So what you're talking about is a small segment. There is a segment that thinks they're going to outperform and has crazy expectations, but it is a small segment. Most of these people have a return target that could potentially be met with a 60-40 global portfolio, which is crazy to me. Because if you can meet your return with minimal complexity and minimal cost structure, why add the cost structure and complexity?
Yes. I mean, Jared, there's kind of an internal struggle going on. Here's the thing. We do vet significant alternative investments for our clients. And Jared, you and we're not against them. I would even say that we're believers in alternative investments as a proper diversifier, as liquid net worth gets high enough. But there's also this thought that as I read through this 90 plus page family office report, Jared, the biggest thing I kept thinking was the Gottschalk's parable from John Bogle. And, the 30-second version of this is John Bogle founded Vanguard, so kind of the father of modern day index fund investing. And he wrote this parable that was essentially the wealthiest families in the world got tired of market returns. And so they were sold this idea that if they pursue fancy investments with fancy investment managers, they can beat market returns. And to no one's surprise, the added cost just ended up eroding their returns, and they ended up with far worse returns than simple public equity investing. And so I thought about that parable a lot of what you just coined. At what point is the complexity not worth it? And again, I say that with a grain of salt because we're believers in alternative asset classes. We can help clients, get margin loans. We can do a massive spectrum of things. And we're not just, hey, close your eyes, pick an index fund and never check it. But it's very much easy to think, what would John Bogle think of this report?
Yeah, it's important that you call out how we feel about alternatives. I don't think the performance is going to absolutely crush what's available in public markets. I do think it could be a substantially uncorrelated return stream.
For sure.
And so what a family office cannot have is a lost decade in US equities, like 2000 to 2009.
Mm-hmm.
Right? That annualized 10% will crush you if you're spending 1.5 million a year and your equity portfolio goes nowhere for a decade. Right? Yep. So I get the allure and hey, let's minimize drawdown. Let's increase sharper. Let's reduce the volatility of the portfolio because there's substantial cash flow coming out on an annual basis for family, for lifestyle, for gifting, right? There's a baseline amount of expenses that's going to come out of the portfolio every year. And so having a lost decade, most investors, and I would argue most family offices cannot afford to do that, especially with all these private investments that have liquidity needs. So I get the alternative allocation, but the question is, okay, what is your motivation for it? Is it return enhancement? Is it diversification? Is it interest, right? Hey, I'm going to invest in these deals because I know the people in them and I can share and I can be in these deals. And honestly, I bet a part of it's signaling, right? Hey, I'm an important investor and important sophisticated investors are allocated to these sophisticated investments. So I think that's also a part of it. But let's just talk about, this is on page 49, just at the 10,000 foot level, the mean, don't have median, unfortunately. Allocation to asset classes, 26% public equity, 47% alternatives. And alternatives is 18% private equity, 14% real estate, 5% venture cap, 5% hedge funds, 4% private credit, 19% fixed income and cash, 1% commodities, and then 6% other. So about half of the portfolio is allocated to alternatives, and then half is really allocated to fixed income, cash, and public equity, so public instruments. I mean, Justin, I'm going to ask you what you think, but I think one of my big takeaways is you never outgrow public equity markets, right? Like these people, they're not all alternatives, right? They've seen these assets work for them. And you never get to a point, even with these people with substantial assets and a family office and full-time employees and a bunch of administration and hundreds of millions of dollars, there's still there are tens of millions of dollars that these families have allocated to publicly available investments, right? So they're good. You never outgrow them. And they can make a meaningful difference on your family's balance sheet. 47% in alternatives, a little rich for my blood in light of what we talked about, but it is fascinating to see that, hey, you never outgrow what's available in public markets.
Whether you have $10,000 or $10 billion, you never outgrow public equities. Absolutely, Jared.
Yeah. So, Justin, I think it's time we kind of put a bow on this in the sense of like, okay, we've just talked about family offices. We do have a few listeners who probably have had the internal dialogue of should I start a family office? But a lot of our listeners are kind of millionaire next door types, or they've accumulated substantial assets, but they're probably never going to have a family office. What is there to learn from this for oil and gas investors?
I think a few things come to mind. One, even if you don't have 100 million, you need great planning. You need comprehensive planning. So the wealthiest families in the world are at the end of the day, a family office is trying to employ excellent planning, investments, estate planning, taxes. You need a high level of planning. The other thing that, maybe you're an oil and gas family who's retiring with $7 million. You don't need a family office, but you do need to think through something that, Jared, we haven't even talked about in this report, and that is family offices are very big on financial education for the next generation. A core tenet that they are trying to execute is how do I train, educate, and build up my children to be incredible stewards of every facet of wealth. And so again, if you have 7 million, you're not going to, formulate a family office, but you do need to think through, how do I set my children up to be an incredible steward of what our family is building?
Yeah, I would say things you never outgrow. Like I said, public investments, you never outgrow a plan for educating and empowering the next generation, right? Like if you think you have those issues now, like not dealing with it and letting assets continuing to compound and underspend is not going to help it, right? You can't ignore that problem. It only gets bigger, right? On page 62, 57% of families are very concerned or somewhat concerned that individuals will have a sense of personal achievement. And it's an issue that they won't have a sense of personal achievement and that the wealth will lead to complacency, right? And we've heard that so frequently from clients. Another 47% say that they're worried that individuals are fiscally responsible and maintain a financially sustainable lifestyle, right? So like these people like you, they're thinking about the same things. You will never outgrow these problems. So a few things need to happen. You need to have a plan. You need to have a professional who's speaking to multiple generations, right? If your advisor hasn't provided any advice on how do I talk to my kids about this? When do I begin gifting? How do I introduce these ideas? You're not being set up for success, and that problem will not go away. So it needs to be dealt with and managed. And I think having a team that's reviewing, I love how they use the assets under supervision. I was knocking it earlier, but assets under supervision matters because you want an advisor that supervises all of your assets and thinks about the balance sheet, how all the pieces works together, right? I think that's a huge thing. And kind of like what you said is like, man, simplicity at all costs, right? There can be complexity if it's warranted. And I would say more on the lifestyle front than on the investment front, but man, really be intentional about why am I adding this person? Is this layer of complexity really beneficial or is it dilutive? I guess I want to leave everybody with one counterfactual. So the chief investment officer of Nevada's pension, Steve Edmondson, I'll share a link to this podcast. He manages a $60 billion portfolio and there's 2 employees on the investment team. And it's mostly passive, right? And so complexity is a choice, right? Your assets aren't going to become so big that you have to add alternatives. And we think there is value to alternatives. And there's a wide variance in terms of how beneficial an alternative can be to your portfolio, depending on why you're pursuing it in the first place. But remember, complexity is a choice. There's a $60 billion pension that is managed with 2 people, right? So you don't necessarily need all this complexity just because it's what larger institutions are doing. And I would argue that it creates this ton of cost friction and a lot of financial incentive to preserve this methodology of that. So I would say simplify. I would find somebody that's looking holistically. And then I would also make sure, hey, that the next generation is being incorporated in this decision making and that your advisor is helping you think through the consequences and the conversations, because it's easier to pass on assets than it is values, direction, mission, purpose. All of those things are harder, but they're equally as important.
And Jared, it's easy to also think about going to extremes, and that if you could only pick one, train up the next generation. It's got to be just so much more important. I mean, you could probably stick $800 million into a total global equity index fund and then just focus on your 3 or 4 kids being the type of people that can steward wealth really well. And that's probably going to be infinitely better than the $800 million family that has a 14-person family office, an incredible array of complex investments, and the kids are not remotely ready to be great stewards of wealth.
Yeah, that's right. I think ideally the family office, in my mind, the family office wouldn't exist because you have a second generation that's so empowered and has such an understanding and direction of the strategy, and it's so simple that it can really be executed with a few people, like just kind of managing payroll, right? Like if you think about, and we didn't talk about this, but the percentage of people that are allocating investments versus doing bookkeeping and bill pay, right? Like a family office, like there's great enough investments to where, like, in simple enough investments to where, depending on your return target, you can get there pretty easily. And it's more about equipping the next generation to feel empowered to do that versus using 3 different layers of managers. But Justin, I think that's a great place to wrap up. Again, we'll link to this in the show notes. Also, if you have an article you would love for our feedback on, send it to us. We love to hear from our listeners and love to get ideas for future episodes. Podcast@brownleewealthmanagement.com. Looking forward to hearing from you. We'll see you next time.